Hey everybody, Joe here from Avalon. In this video, I'll explain in plain English how your personal taxes work in Canada. If you've ever wondered why they didn't teach you useful stuff in high school, like how taxes actually work, then this is the video for you. Luckily, you won't have to sit in a dank portable for an hour a day for 6 months to learn this. In under 30 minutes, you can go from tax beginner to knowing more than 90% of Canadians about personal taxes. Don't worry though, the video is much more interesting than it might sound.
Oh, really?
You're going to learn how your money is taxed and the types of income and deductions that allow you to reduce that tax. Stick around to the end and I'll show you how to easily estimate your tax refund in less than 2 minutes. All that and nothing else coming right up. All right, we're breaking the topic of taxes in Canada into two different videos. The first video, that's the one you're watching right now, is all about personal income taxes. The second video, linked in the description below, dives into corporate taxes in Canada. Corporations allow business owners to access lower tax rates, as well as some truly excellent government programs that help you build wealth.
Excellent.
For now, though, we're talking about personal taxes. In the Canadian tax system, there are two types of income tax for individuals: federal income tax and provincial income tax. These separate taxes have their own tax rates and they stack on top of one another. For example, a Canadian living in Alberta earning $180,000 a year of taxable income will pay about $53,000 in income tax. That includes both federal and provincial income taxes. If that same Canadian lived in Nova Scotia, she would owe around $64,000 in income tax. The difference comes from the different provincial tax rates between Alberta and Nova Scotia. The person would owe $11,000 more in taxes just from living in Nova Scotia compared to living in Alberta. Wow, Nova Scotia must be really nice. With both federal and provincial taxes, the percentage of tax you pay increases as you earn more income. This is called a progressive tax system and is our next topic. In Canada, we use a progressive tax system. This basically means that your tax rates increase as your income increases. You may have also heard it described as tax brackets or marginal tax rates, but it all means the same thing. The best way to explain the concept is to demonstrate it with an example. We'll use fictional marginal tax rates to illustrate the point. You can see an example here. The tax rates increase as your income increases. Each higher tax rate is only applied to the taxable income within its own bracket. So running down the list here, the first $20,000 is taxed at 0%, no tax on that. Between 20 and 40 is at 10%, between 40 and 60 is at 20, between 60 and 80 is at 30%, and the income between $80 and $100,000 is taxed at 40%. So in this fictional example, I want to stress that, the total tax payable on $100,000 of income is only $20,000. There's a common misconception that the new higher tax rate will be applied to all of your income. You hear people saying they don't want to earn more income because it will put them in a higher tax bracket. That is the wrong idea.
This is all wrong.
The higher tax rate is only applied to the income within that tax bracket. It's an important concept to understand. All else things being equal, it's always better to earn more income. Don't turn away extra income because it puts you in a higher tax bracket. It's the wrong idea. There are also different tax treatments for different types of income in Canada. I'll use some of the most common income types to illustrate this concept. I'll talk about employment income, investment income, and we'll talk about business income as well. So I'll start with the most common type of income, which is income from employment.
It would be nice to have that kind of job security.
But if you've ever been employed in Canada, you likely received a T4 slip that shows how much employment income you earned in the year. Employment income can include wages, salaries, bonuses, and commissions, among other forms of compensation. When you receive employment income, you are required to pay federal and provincial income tax on those earnings. Your employer will typically withhold this tax from your pay and remit it to the government on your behalf. Really nice of them. You will also see Canada Pension Plan contributions and employment insurance premiums deducted from your paycheck. You'll likely have seen these abbreviated as CPP and EI. This example here shows a pretty typical T4. Pam here has earned $58,000 of employment income, which you can see in box 14.
Pam!
Her employer deducted $3,100 of CPP and remitted it to the government. That shows up in box 16 on Pam's T4. You can also see in box 18 there were $915 worth of employment insurance premiums deducted and remitted to the government on Pam's behalf as well. Then the biggest deduction we see is $9,000 worth of income tax that was withheld. This amount shows up in box 22. The T4 is how employers report your employment income and taxes paid to the government each year. Your employment income and the income tax withheld is taken into consideration when you file your tax return each year. Keep that in mind for now. Later on, we're going to be looking at how your overall taxes are actually calculated and how you can estimate your tax refund or amount owing each year. Here we can see Pam's employment income on her tax return. Her employment income of $58,000 shows up at the top of her total income section. We'll come back to this example as Pam earns different types of income and claims tax deductions and credits. I'll also note that so far Pam is expecting a tax refund of $305 because her employer withheld more income tax than is currently calculated on her return. This will change as Pam earns other types of income where taxes are not withheld and paid automatically like they are with employment income. So next we'll look at investment income and how it's taxed. There are a few different types of investment income, but I'll focus on dividend income, interest income, and I'll also talk about capital gains. Interest income that you earn is fairly straightforward. It is included in your taxable income and taxed at your marginal tax rates. There isn't any preferential tax treatment for interest income, but that certainly doesn't mean that you should avoid it. One way to improve how your interest income is taxed is to hold these investments inside a TFSA or an RRSP. Earning interest within a TFSA or RRSP means that you don't actually pay any tax in the years that you earn that income.
That's interesting.
To learn more about how TFSAs and RSPs work, check out our video linked in the description below. We explain how they work and when you should use them. So that's interest income.
That's fucking interesting.
Dividend income, on the other hand, is taxed at a lower rate than interest income or employment income. You earn dividend income as a shareholder of a private or publicly traded company. Because dividends are paid from after-tax dollars of corporations, they have preferential tax treatment on your personal taxes. It's a bit convoluted sounding, but here's how it happens. First, the dividend income is grossed up, aka increased by a percentage. This grossed up amount is included in your total income. Then a dividend tax credit is applied to reduce taxes paid on that income.
Excuse me? Baking powder?
There's a lot more we could talk about with how dividends are taxed, but the basic premise is truly what's important here. The main thing to understand is that dividend income typically creates less personal tax than the equivalent amount of interest income or employment income. This table is a great illustration of that point, so check that out. You can see that the tax rates on dividends are much lower than tax rates on employment or self-employment income. If you're curious to learn more about how dividends are taxed, check out the link in the description below. Next up, we've got capital gains. So capital gains arise when you sell property for more than you paid for it. And now when we're talking about property in this context, we're not necessarily talking about real estate. Property can mean real property, but it can also mean investments like shares in a publicly traded company. When you sell your investment at a gain, your capital gain will be equal to the selling price minus the adjusted cost base of the property. Now, adjusted cost base just means the amount that you paid for the purchase of the property plus any expenses paid to acquire it, like commissions or legal fees. You're only taxed on half of the capital gain that you earn. For example, if you sell your Shopify shares for $10,000 and your adjusted cost base was $2,000, then you'll only pay tax on one half of the gain. So the $8,000 of gain means a $4,000 taxable capital gain. Okay, let's have a look at what investment income looks like on Pam's tax return. We can see that Pam has earned dividend income of $100, which has been grossed up to $115. We'll see how the dividend tax credit reduces her taxes on this income later in the video. We'll also see on the investment income lien that she's earned $1,000 of interest income. And she also earned a capital gain of $10,000, but only half of that is her taxable capital gain of $5,000. So far, Pam has earned employment income from her work at Dunder Mifflin's Vancouver office and some investment income. Her total income is $64,115, and she's now expecting that she will owe $1,400 in taxes. The change from an expected refund to owing tax happened because she earned investment income without remitting tax like she did on her employment income. This is normal and why people with significant investment income can often have a balance owing when filing their taxes.
Double the taxes.
All right, moving on. Lastly, we'll look at income from self-employment. Self-employment income is commonly referred to as business income. This is an interesting one because you're allowed to deduct many types of expenses that you've incurred to earn that business income. You're then taxed on what's left over after you've deducted all of your business expenses. As usual, an example is the best way to explain this. Here we see that Pam has a side hustle as an artist. She has sold $26,000 worth of her art this year, and she's also incurred some expenses for advertising, office supplies, and travel costs. Her net income after deducting those expenses was $21,300. This is also the amount that we see here on the line for her total self-employment income. Business income is great because there are more available deductions that allow you to reduce taxes that you pay. Check out the link in the description below to learn more about what types of expenses you can deduct when earning business income. All right, now we have a good picture of Pam's income. She's earned $85,415 in total income, which you can see on line 15,000. This also includes her income from employment, her investment income, and her self-employment income. If that was the end of Pam's story here, we would calculate Pam's taxes based on her total income of $85,415. She'd be expecting to pay around $8,000 in taxes. This might sound like a lot of tax, but it would have been even more if Pam wasn't able to deduct business expenses to reduce her income from self-employment. Again, the reason her taxes have jumped up is because she's earned more income without paying taxes throughout the year. However, it's not the whole story. Pam still has some tax deductions and tax credits that are going to help this situation. Next, we'll look at some common tax deductions available to Pam. These will reduce her taxable income, which reduces her taxes owing. Don't confuse tax deductions with tax credits because they behave differently even though they sound like they do the same thing. Tax deductions reduce your taxable income, whereas tax credits reduce your income tax.
What are you talking about?
Okay, I know it sounds confusing, so let me break it down a bit further. So Pam had just over $85,000 of total income. Let's say that she had $10,000 of tax deductions. This would reduce her taxable income to $75,000. And then that number would be used to calculate her taxes owing. Her total tax would only drop by $4,000 in this example because $10,000 deduction only reduces the income used to calculate those taxes. Tax credits, on the other hand, directly reduce taxes payable, but there's an extra step needed to calculate them. Tax credits create tax savings based on the lowest tax bracket, which is 15% on the federal side. So a $10,000 federal tax credit will reduce federal tax by $1,500. Applying that back to our example, if Pam had $10,000 of tax credits, her taxes owing would only reduce by $1,500. All right, now that we maybe know the difference between tax credits and tax deductions, let's look at a few common tax deductions. In this example, Pam has tax deductions from her RRSP contributions, childcare expenses, and moving expenses. You'll see on her tax return that there are a number of other deductions available to her, but we've chosen 3 of the most common ones to cover in this video. RRSP contributions are probably the most common type of tax deduction that we see. Contributing to your RRSP allows you to deduct that amount from your income, which means that you're taxed on a smaller amount of money. There's a maximum amount that you can contribute and deduct each year, but RRSPs are still great because they reduce your tax and help you save for retirement. Check out our video linked in the description below for our full guide on RRSPs. Pam has $5,000 of RRSP contributions, which will reduce her taxable income and save her about $1,400 in taxes. Pretty nice. Next up, Pam had some childcare expenses. There are quite a few specific rules around who can claim childcare expenses and how much can be claimed. In general, though, childcare expenses can be deducted by the lower income earning spouse up to a maximum amount. Now, the maximum amount is, list coming, $8,000 for each child under 7, $5,000 for each child between 7 and 16, and $11,000 for each child who qualifies for the disability tax credit. There is also an overall maximum equal to 2/3 of the earned income of the lower income spouse. Pam's husband, Jim, has had a really good year with his sports marketing company, so Pam is the lower income spouse and will have to claim the childcare expenses on her return. Pam and Jim paid $10,000 in childcare expenses for Cece, but the maximum Pam can claim is $8,000. This is because Cece is under 7 and doesn't qualify for the disability tax credit. The $8,000 child care expense deduction reduces Pam taxes owing by about $2,200, so that's pretty good. The last tax deduction that Pam had was moving expenses. Moving expenses are deductible if you've moved and established a new home to be employed or run a business at a new location. You also need to have moved at least 40 kilometers closer to your new place of work or business. If you've met those requirements, you can deduct things like transportation and storage costs, travel expenses, temporary living expenses, incidental costs related to your move, and various rehoming costs. For a full list of eligible expenses, check out the link in the description below. In Pam's case, she was transferred to the Dunder Mifflin, Vancouver office and incurred $10,000 in eligible moving expenses. This deduction reduced Pam's taxes by about $2,800. Here we can see that Pam had $85,415 in total income before any deductions. Then we deduct $5,000 of RRSP, $8,000 of childcare expenses, and $10,000 of moving expenses. We arrive at Pam's net income of $62,415 on line 23600. Next, we can see that there are a few other deductions that could be deducted from Pam's net income before we arrive at her taxable income. These didn't apply to Pam, so her taxable income is also $62,415. Pam's federal and provincial income tax is calculated based on this number. Her marginal tax rates are applied to her taxable income, and we can see that Pam would owe $10,000 in federal income tax plus $2,800 in provincial income tax. However, that's not the end of the story.
There's so much more to it than that.
We still have tax credits to account for before we find out how much Pam owes or if she gets a refund. Like I mentioned earlier, tax credits reduce the actual tax amount that you owe. There are different provincial tax credits available depending on which province you live in. And there are federal tax credits that are available to all Canadians. We'll look at a couple of the more common federal tax credits to illustrate how they work. The most common tax credit is the basic personal amount. The basic personal amount is just one of the non-refundable tax credits every Canadian resident can claim. The amount of the credit changes from year to year, generally to keep up with inflation. In 2022, the federal basic personal amount was equal to $14,398. There is also a corresponding provincial basic personal amount, which varies depending on which province or territory that you live in. Pam certainly qualifies for the basic personal amount as she's a resident of Canada in our fictional example. The other tax credit that we'll discuss here is the home buyer's amount. In 2022, you can claim up to $10,000 for the purchase of a qualifying home if you meet a couple of criteria. You or your spouse acquired a qualifying home, and in the last 4 years, you didn't live in another home that you or your spouse owned. Now, for it to be a qualifying home, it must be either a single-family house, a semi-detached house, a townhouse, a mobile home, a condo, an apartment in duplexes, triplexes, fourplexes, or apartment buildings.
Okay, thanks. I get it.
Okay, so the criteria for a qualifying home does cover most scenarios. The tax credit can be split between spouses or claimed fully by one spouse. In our example, Jim and Pam bought a house in Vancouver, and Pam is going to claim the full amount on her return.
Greedy, deceitful.
We can see here on Pam's return again that she has the basic personal amount of $14,398 at the top. Then she has a few other tax credits that are important, but that we didn't have enough time to cover in this video. And lastly, we see the home buyer's amount of $10,000. At the bottom, we'll total up the tax credits and multiply that by 15%, which is the lowest federal tax rate. That gives us federal non-refundable tax credits of $4,500-ish. This amount is subtracted from Pam's federal taxes owing. Okay, so now we're almost ready to find out how much tax Pam will owe. At the top, we can see federal tax of $10,034 was calculated based on Pam's taxable income. Then we're reducing that balance by her non-refundable tax credits of $4,445.90. And we get to deduct that $10 federal dividend tax credit that arose from Pam's dividend income. Next, we add in CPP that Pam will owe on her self-employment income of $799.60. CPP is a bit beyond the scope of this video, but check out the link in the description below for more info on that. And finally, we add in Pam's provincial taxes owing of just under $2,900. So her total taxes payable is $9,272.25. Thankfully, Pam has already paid the $9,000 in tax that was withheld from her employment income. This amount gets deducted from her total tax payable, which means that she will only have to pay a small balance owing of $272, which when she files her tax return.
Thank God.
So we've looked at a simplified calculation for taxes for Pam, but it's still not that simple. However, there is an easier way for you to get a reasonable estimate of your tax balance. and that's using the Wealthsimple tax calculator. No, they're not a sponsor. It's just a free online tool that is straightforward to use that we use all the time. Click the link in the description below of this video, and then just fill in a few fields on the calculator. Choose your province, income amounts, RSP contributions, and income taxes already paid. It will then give you a pretty good idea of whether you'll have a refund or a balance owing when you go to file your tax return. For example, if you've earned $65,000 of employment income and your employer withheld $12,000 of income tax, you could estimate receiving a refund of around $1,400. Woohoo! All right, that's it for part 1 of how taxes work in Canada. Hopefully this video has helped you, give you a good idea of how your taxes work and how they're calculated. If you want to dive into more topics like this one, please check out our links in the description below. We've got articles, guides, online courses, and lots of other resources for you. We do love helping small business owners, and creating these videos is just one way that we do that. But if you're not subscribed yet to our channel, please consider hitting that subscribe button. And if this video has been helpful, please hit the like button too. That's super helpful for us. It really motivates us to get out there, put more useful content out to you guys. And thanks for watching, and we'll see you in the next video. Cheers.